In order to develop portfolios and subsequently evaluate their performance, investors are required to develop a clear understanding of what are meant by the concepts of risk and return. So the basis of understanding risk and return goes back to the idea of utility theory. That is the question of what investors are actually seeking to achieve when they invest in financial markets. All investors seek to maximize their utility. That's the very reason they're participating in financial markets in the first place. So when we're trying to evaluate the performance of a portfolio, our question is, are we actually maximizing utility for the individual investor for whom we are investing on their behalf? So the question really becomes, what is utility and how is it measured? Well, utility is an abstract concept that can be summarized as measuring the overall satisfaction that one gets from investing. But if we're trying to measure satisfaction, we're measuring a concept that is largely intangible. It's an abstract concept that can't be defined. So because in financial markets we like to be able to measure performance, we need some way of being able to measure utility. So a starting point is to recognise the concept of diminishing marginal utility. That is, we generally find that there is a principle that the more that you get of a particular good, the less that you actually value that good across time. A simple example often used by economists is to think of the value that you get from the purchase of a can of Coke. Imagine it's a hot day and you're really thirsty and seeking a drink to quench that thirst. The first Coke that you buy and drink, you'll derive a lot of utility from because it's really quite beneficial and you feel much better after it. You then buy a second can of Coke, you might get a little bit of utility, but much less than the first time round. Every subsequent can of Coke that you purchase and you drink, you're getting less satisfaction out of it, less utility. Well, we actually find that the same principle occurs when we look at wealth. That is, the value of every additional dollar is actually less to you the more money that you have. This again is quite a straightforward concept that tends to make sense. Think about if I were to give a cheque for $100 to one of two people. One of those people might be a multi-billionaire, and the other one might be a poor university student who only earns a couple of $100 a week in their part-time job. Who would value that $100 more? Well, clearly the university student. And the reason for that is because we find that utility diminishes as our level of wealth increases. Now, an important concept of this idea of diminishing marginal utility is that given we get less value out of each additional unit of wealth that we're given as we get wealthier and wealthier, we're going to be more averse to taking on risk in order to capture that additional wealth that we can achieve. Or another way to think about that is that we would rather a certain outcome rather than a risky one. I think here about a coin toss game, where the coin toss game you might have two possible outcomes. You might toss a coin, and if it lands heads, you might get $150. If it lands tails, you might get given $50. And imagine the alternative is just to get $100 wealth given to you. So what we've got here at W2 is the utility that one would get if they were just given $100. Okay. Alternatively, we have the coin toss game. And for the coin toss game, they might get either $150, and we've got here the utility that the investor would get from that, or they might get $50, and here's the utility they would get from that. And if we draw a straight line between those 2 points, and we find ourselves, well, what is the utility that the investor gets from this particular investment, this opportunity where there's 50% chance of getting $150, 50% chance of getting $50, we find that the utility level they achieve is less than the utility they get from the certain $100. Okay, so because these are two outcomes where in both cases the expected return is $100, so the cash value is the same, so there are certain $100, or a game where the expected value is $100, but because of the risk associated with the game, with the coin toss game, the utility is less. So this is the concept of risk aversion, and this is what brings us to the idea that investors are risk averse, and that risk can actually decrease our utility. So that brings us to the idea of risk and return. Now, when investors are making decisions, they need to focus on not past returns, but expected future returns. Expected future returns are comprised of two elements. The first component is the risk-free rate of return. Okay, so that's basically the return that you get in order to defer consumption in the future. Okay, or it's the rate of return that can be earned with certainty, with no risk at all. On top of that benefit or reward you get for deferring consumption or taking on the risk-free rate is the additional return that one gets for bearing risk. Okay, we call this the risk premium. And obviously the risk premium gets higher as the level of risk increases. And that's what brings about our risk-return relationship. Higher risk, the higher this risk premium, hence the higher overall expected returns, given expected returns are comprised of both the risk premium and this constant risk-free rate of return. Okay, so as I said, when it comes to actually looking at determining what an investor should invest in or how we should manage our portfolios, investors really need to consider expected returns, not historical returns. Because we find that in an efficient market, if markets were perfectly efficient, returns should be independent of the historical values. History should have very little implication for the future. Again, let's look at a simple example here. Let's imagine that you're in a casino and you're on the roulette wheel. So in roulette, there are 37 slots, each of which are equally likely. So it's an equal probability to get in any of those 37 slots. Okay, we've got numbers 0 through to 36 on the roulette wheel. So the question is, last spin on the roulette wheel landed at number 0. If we landed at number 0 last spin, what's the probability of landing on 0 again next spin? Well, what we know is the probability is 1 in 37, given 0 is equally probable to the other 36 numbers on that wheel. And the fact that it landed 0 last spin should have no implications at all for where the ball is going to land next spin. Okay, this is the idea that a roulette wheel is unbiased, and hence the roulette spin we can one think of as being like an efficient market, where we can't use the past to explain the future. Another way of looking at this is to step through history and actually have a look at what did portfolio returns or equity market returns look like across the period 1945 to 2010. And on this slide, we've broken those returns down into 4 approximately equally spaced subperiods. What we can see here is that in the first subperiod of 20 years, the average annual geometric mean return was a bit over 10% per annum. So quite a large return, 10.51% per annum. So if you're then at 1964 and you're predicting returns for the next period of time, well, if you had just extrapolated forward this past return, you might have thought, well, it's actually going to be quite a fruitful period of time. When in fact the opposite was the case. The next 17 years, the average market return was actually a negative. Subsequent to that, we then had an 18-year period that were once again quite fruitful, huge returns, 14.72% per annum on average between 1982 and 1999, before we have a period here which obviously in the middle is the global financial crisis, hence average returns are again actually quite negative in this period. So we can see here that if at any one point in time you're using the past to try to explain future returns, the past aren't really indicative. You can't just extrapolate forward what's happened previously. So historical returns are a quite poor proxy for expected future returns. So what's the alternative? Well, the alternative is that we use asset pricing models. Asset pricing models go back to this idea that expected returns comprise the two elements that we spoke about before. Remember, they were the risk-free rate of return and the risk premium. And basically what we do is we get a measure of expected returns by estimating our risk premium given the level of risk of our investment. So that begs the question, therefore, if we're looking at measuring expected returns as a function of risk, or we're looking at this risk-return trade-off, what does risk actually mean? Well, if we think about risk in terms of many ways that it's defined within Western dictionaries, we know that risk is often associated with a negative connotation. For example, the Webster Dictionary defines risk as being exposing to danger or hazard, quite a negative term there. However, risk in financial markets really just means uncertainty. It means variability of possible outcomes. Therefore, risk does not necessarily have to be an entirely negative concept, and in some ways we can think of the Chinese symbols for risk, which are reproduced on this slide, as giving a much better description of what risk actually means. Because in the Chinese symbol, they've got a combination of both danger and opportunity coming together. Okay, so danger and opportunity, and that's very much what risk is, because in financial markets, when you have uncertainty, you have an increased variability of possible outcomes. With that increased variability, sure, comes the danger, possible downsides, but also comes the possible opportunities, because the range of outcomes are getting broader. Hence, we've also got more upside potential from a risky asset, as well as more downside potential. So, when we think about trying to maximize an investor's utility, and we think about these ideas of risk and return, the most commonly used measure of utility in financial markets that's used in terms of portfolio theory and evaluating the performance of portfolios is mean variance utility. Mean variance utility is really important because it assumes that investor utility is only comprised of two elements. It assumes that investors only care about the expected returns and the risk of their investment. So investors only look at that risk-return trade-off and nothing else, whereby they like higher expected returns and they dislike higher risk. However, more importantly, under mean variance utility, risk is measured as the variance of the asset that the investor is holding. Okay, so if we think of this in terms of statistics, the expected return is just the mean or the average return of all the possible return outcomes, and we can see we've got the equation for that here. And the risk is the variance, which is basically a statistical measure of the spread of possible outcomes. Okay, so if we think about this as a distribution, so what we've got here along the x-axis are all the possible return outcomes. Okay. On the y-axis, we've got the probability of achieving any of those outcomes. And we can see that the probability is following a normal distribution in this case. So the mean would be, if we look at all the possible outcomes, the mean is the average. And in terms of that normal distribution, it's the value in the middle. And the variance is a measure of the spread of this distribution. So if we had a bell curve, for example, that was fatter, that would be, it would have a larger variance of returns. It's where we've got greater risk because there's greater uncertainty. There's a greater range of possible return outcomes. Where if we had quite a narrow bell curve here, we'd be saying that in that particular case, we've got an asset that has quite a low risk, considering how we've measured risk and return. So, in terms of our mean variance utility, we're thinking about risk as being measured by variance. And that's always the appropriate way of thinking about risk. But the question is, what if we're thinking about looking at the risk of some asset that we're going to go about adding to an existing portfolio? So if we're looking at adding an asset to an existing portfolio, we're not necessarily so concerned with the risk of that asset itself. We're concerned with the effect that the risk of that asset is going to have on the risk of our existing portfolio. Hence, what we need to consider is the marginal effect that that asset will have on portfolio risk. And that's where the idea of systematic risk, or beta, comes in. Because we know that the risk of an asset is comprised into two categories, systematic and unsystematic risk. So unsystematic risk is the firm-specific risk, the risk only associated with that particular asset. And that dimension of risk is actually eliminated through diversification. Systematic risk is a measure of exposure to market risk. So it explains the risk of a diversified portfolio, and it's the component of risk that is not eliminated through diversification. Hence, it gives us a measure of this marginal effect that the asset will have on the portfolio. So that's why often, if we're measuring the risk of an individual asset, we consider that asset as being one part of an overall portfolio. Hence, we think about the risk as being just the marginal contribution, so we think about beta. That's what brings us to this equation we see down the bottom here, this CAPM model, the capital asset pricing model. The CAPM says that the expected returns of any stock should be the risk-free rate plus beta. Beta is our measure of our sensitivity to the excess return on the market, and then we've got that excess return of the market in here. So in this particular case, an asset's beta is its exposure to market-wide risk, or it's its measure of systematic risk. And what we can actually do is we can actually use data to estimate beta for a particular stock. Okay, so to give an example here, we can find that if we plot each of the historic data, historic market returns and historic excess returns of a stock on an X and Y axis, we can fit a regression line, which is the line of best fit that fits through that data, and the beta is the slope of that line. Okay, where the steeper the slope, the more sensitive the return of the stock is to a change in the return on the excess market return. Now we can actually access this for ourselves, and as an activity in your own time, I suggest that you go onto the Yahoo Finance website, download historic data for BHP, and actually estimate the CAPM for yourself. If you do that estimation, you actually find the following results. What you find is that down here we've got our regression output. We find that BHP, the coefficient, which is the beta value, is 1.176, which is telling us that BHP has a marginal level of risk, or it's got a beta, a systematic level of risk, slightly greater than the average stock on the market. Okay, because we know that the beta of the market is 1, so a value of beta greater than 1 means it's got slightly higher systematic risk than the market portfolio itself. So on average, we would expect that adding BHP stocks to our portfolio would actually slightly increase the risk of that portfolio. Obviously, the trade-off is we would also expect BHP to have a slightly higher expected return compared with other stocks. So, how, therefore, overall do we go about measuring risk? Well, yeah, it's quite difficult. We can think of risk as variance. We can think of risk as beta. But in both instances, there are some problems. Okay, there are some problems because when we looked at measuring beta, for example, we were focusing on these models such as the CAPM. But we know the CAPM has difficulties. First of all, we need to be able to define both the risk-free rate and expected market returns. But we don't know with certainty what these values are. Also, there's a whole lot of empirical evidence that says that the CAPM is actually does not have 100% explanatory power in terms of explaining the returns of stocks. That is, the CAPM is a less than perfect model of itself, and potentially there are other factors other than just that market risk premium that are also risk factors that might explain returns. The CAPM and the theory based on the relationship between expected returns and risk that underpins it is based on the notion that markets are perfectly efficient. But you might be an investor who holds the philosophy that markets are less than perfectly efficient. Maybe you think that prices are subject to irrational exuberance, and in that case, again, maybe the CAPM is not efficiently pricing stocks. The CAPM also, when we use beta, remember, is assuming that you're only looking at the marginal component of risk. So it's assuming that you're adding a particular asset or stock to a well-diversified portfolio. But we know many investors are actually not, in fact, well-diversified. So again, this could be a possible flaw. And last of all, in terms of both beta and variance, as we spoke about before, it captures both upside and downside volatility. So this measure of uncertainty is capturing both the danger and opportunity associated with risk. But while investors are averse to the danger of risk, they don't like the potential downside, they actually like the opportunity. They like the potential upside. We like the chance to gain a whole lot of money. Hence, maybe it's important to look at measures of risk that tease out the difference between the danger and the opportunity, and look at upside and downside risk separately.